Hi everyone, welcome to the market update featuring by Market Soul and Rationale. Today I'm diving into the latest market updates, breaking down key developments from the economic calendar. Volatility has spiked a lot with a massive sell-off in the S&P 500 and cryptos, while funds are flowing into fixed income instruments. Let's find out what's driving this market pricing. Here in this screen you see as usual our economic calendar. It's starting from the last Wednesday when our latest video published up until right now. First of all, as you can see here, the New Zealand Reserve Bank of New Zealand interest rate decision was expected, and as expected it came at 3.75, which is a 50 basis point rate cuts. I had mentioned that there were a potential New Zealand dollar short opportunities are arising against some particular currencies that I will also mention today. There are some opportunities that are still arising there in the chart section. Then we received UK CPI number. As you can see here, the actual number came in 3%, which is higher than the forecast and the previous number. Also, we had mentioned that there are a stagflation risks still ongoing in the UK side. Their Bank of England members had also revised in their latest meeting that their inflation expectations up. That's why I had mentioned that I see pound still strong. And then after I think our video recorded, FOMC meeting minutes was released, and the main the most important part in the meeting was, I think, they considered they talked that housing balance sheet runoff to keep some cash flowing into the system. What's the point of it? First of all, what's balance sheet runoff? As you might, some of you all know that they were reducing balance sheet. That means they are not reinvesting to the treasuries that are expiring. That means they are sending less liquidity. The Fed sends less liquidity to the market, and that means balance sheet runoff. When you pause this activity, that means you will keep buying at some portion, and that means you provide some liquidity into the market. When would you do that? If you see the market is not, economic activity is not doing that well, a credit side is also credits are declining and stuff, you want to add some liquidity into the market, and in that situation you would provide some liquidity by pausing balance sheet runoff. And what's the reason that they were debating is highly correlated with the treasury market, which is an upcoming uncertainty, especially with debt ceiling talks that potentially coming up. Along the time, always, there's a debt ceiling is put by Senate in US, which is the limit of US Treasury that is allowed to borrow money. And when it's come to at some level, they're going to Senate asking permission to increase those limits, and that always brings some uncertainty into the market. It wasn't like this actually, but lately the total debtness of US has reached record levels. That's why this DOGE, DOGE, Department of Efficiency, Government Efficiency, Musk's this initiation and stuff. These are trying to save some money from government's spendings. And yeah, that's still that's a huge issue for in a macro level, that how sustainable with this much of debt for a country. If you look from a perspective of a company or something, it's definitely not healthy. But when the case is US, it's a reverse, reserve currency of the world. It's a bit different. Yeah, that was the main topic that I wanted to mention about FOMC minutes. Then we received a Philadelphia Fed Manufacturing Index, which came as you can see, previous number was this, and the actual number is 18. It's a huge decline. in this video, the major focus should be on economic growth. I'll touch on that a bit. And this was the, I think, first data that I saw that, okay, like economic activity, I need to switch, like shift my focus a bit on economic activity. That was the first alert that I received from the market. And then on Friday, we received like a PMI numbers. As you can see in this screen, the global composite PMI, the previous number is 52.7 and actually 50.4. And manufacturing side is increasing actually from like a forecast 51.3 to 51.6. But the service side is declining. That's the concerning part. Yeah, that's like, this is like a pretty important part, I think, because service sector is slowing down, but manufacturing is picking up. Why? I think Trump related risks involved here, like general, like potential tariffs, like kind of like spooking the service side. Companies might, like, general mentality. What's the general narrative? First of all, tariffs gonna come up, price is gonna increase, that will create some inflation, and since the inflation is created, Fed will slow down on rate cuts. That's the main narrative. But generally, I don't see that the impact of tariffs on economic growth is not it's not like debated a lot, because when you put tariff on, that extra cost will be compensated by different agents of those transactions. For example, suppliers from China will face with some proportion of that extra cost, or the buyer company in US. What does that mean? A profit margin of some portion will be compensated. That tariffs will be offset by some profit margin of those companies, and which is bad for economic activity. That's why we see some bad impact of tariffs on service side. When you come to the manufacturing, it looks like a kind of like a solid compared to service side. Why? Because like businesses are trading early to beat any tariff hikes. They're kind of preparing themselves in front. They're doing those transactions, whatever they can. They're stocking up, kind of that mentality. I think with that mentality, focus used to be on interest rates. Like a lower rates meant like a pumping up stock and like a risky environment. But now it's shifting a bit to like a recession worries, like which is sparking sell-off in stocks with the mentality that I mentioned, with the narrative that I mentioned, that profit margin side of companies. Definitely this is the rate side, rate narrative, and like a recession narrative. It's difficult to separate those from each other. They're for sure connected, but tariffs might hurt growth more than they push inflation up. That's the new thing that's we need to consider. And I think the first alert was came from the Philadelphia Fed Manufacturing Index, and then S&P service side, S&P PMI Numbers service side showed that. I still see these sell-offs as chances still to buy, especially with a positive outlook for the end of 2025. This year, my mentality is splitting things, one portfolio for active trading, more like a short-term, like kind of a swing mentality, take the position, maybe hold I don't know, 3 weeks or something, sell. That's one side. And the other one is a big, stable, more like a long-term picks, buying at maybe a dollar cost averaging at some point, or some doing a portfolio from now on by targeting the end of the year. But my current mentality is leaning more toward the stable side, more long-term side this year, because of the volatility that is expected this year. And we're experiencing from the beginning of this year that volatility is too high. It's so difficult to manage. That's why maybe like a long-term portfolio, you should put more weight of your fund on the long-term one. That might be more wise. It's all about a waning interest rate effect versus recession risks. Right now, I think on pricing, recession fears are a dominating market pricing. I'm definitely keeping an eye on labor market first of all. Okay, we received some numbers from PMI numbers and the Philadelphia Manufacturing Index, but definitely non-farm payroll number or average hourly earnings. I mean, that data will play crucial role in the upcoming days. Also, this week we have like Nvidia earnings that will be also highly impactful for sure for the market pricing. But just to repeat, I'll keeping an eye on labor market, people keeping jobs. As long as they keep their jobs, they will spend, because main concern here is if the people spend less, that will hurt definitely service side. In order to measure it, their status of being employed is the most important factor. So quickly, let me skip to Forex market overview. First of all, about dollar index, it's my view is still like a neutral. The US dollars getting sold off last 2 days as rates drop, thanks to the reason that we have covered, that potential impact of a recession that push yields a bit down. Growth worries outweighing the inflation. That mentality pushes dollar index down. Multiple currencies are bearish, and the dollar only holds up if risk aversion spikes or Fed stays hawkish than expected. On the pound side, the UK was set for they were set to rate cut, but the sticky inflation, they're rethinking their current status. They're now expecting higher inflation, and as I mentioned, the latest data is higher than expected. That's keeping the pound stronger than it might have been. Japanese yen, it's still pound and Japanese yen, I'm bullish on these currencies against the other ones. Japan's sticking to its rate hikes, making the Japanese yen look good compared to currencies with lower returns. That's rate difference trade mentality. Also, their GDP came higher than expected, which is which was their biggest concern. They were unable to create some inflation. They weren't able to grow, and they started to do that. That's why, that's the. But still, rates are okay for them. On the Aussie side, Australian dollar, I'm bearish on it. Rate cuts on the horizon after earlier inflation worries. Lower rates are dragging Aussie dollar down. New Zealand dollar, same. They cut rates by 50 points in the last meeting. Eurozone side, they're they're leading the charge on rate cuts. They're ahead of the other central banks. With that mentality, for example, in EURUSD, I'll be on more USD long side, especially for short-term trades. Canadian dollar is, I think, the most complicated because it's impacted. Canada's cutting rates too, Eurozone. They're so their path is so similar. But a surprise inflation jump in January adds uncertainty. That's the first thing. And also, Canada is so sensitive to tariffs. Plus, Canadian dollar is highly tied with oil price, which is highly impacted by geopolitical tensions. So Canadian dollar, I think there's a huge mumbo jumbo going on there. It's so difficult to forecast what's going to happen with the Canadian dollar. So let me skip to chart side, technical analysis side of our video quickly. First of all, I'll start with US 10-year yields. Here you can see the weekly chart, and there's a parallel channel that I've been following. With this latest shift from inflation to recession risks, we see that this 10-year yields are coming down. Just to this, when this happens, that means dollar index is weakening. But let's look flip the coin and look from the other side. For example, this SHY ETF, which is 1 to 3 year treasury bond ETF. As long as this chart goes up, that means yields are coming down. And as you can see here, there's a head and shoulder bottom chart pattern is formed, and a breakout occurred here. We'll see how this is going to act. This was one of the trade idea that I sent in a rational FX ETF report on Tuesday. If you subscribe from the link below, you can also receive this kind of trade ideas directly to your inbox. And here you can see a potential breakout would need more high, like a lower yields, and that's how I'll be monitoring on the yield side. Euro dollar on the higher time frame, as I mentioned, like euro dollar down, like a downside scenario is more likely to me. That's why this pullback, I would try to use this pullback as a shorting opportunity, just as a like that kind of. I would bet on that. I will bet on that way, and like maybe if you come to like a 4-hour chart pattern. Sorry, yeah, seems like if a breakout occurs from here, I would be for sure I wouldn't touch. But if I just like stubbornly want to trade euro dollar, I would seek for a potential downturn from here, which means like maybe being like a short to expect such move. Let me show you like this potential short position, like around here. You can also like just give a shot around here as well with like stop loss around here, just to take this high as a stop and aiming to go lower. That might be one opportunity. So yeah, Euro Japanese yen. When this is like a 1-hour chart, I would like to show. Sorry, I want to start with the weekly chart first of all. As you can see, this Japanese yen trades might act. It might be soon. That means Japanese bullish scenario. What's this like? A potential breakdown would mean weaker euro, stronger Japanese yen, and this is the first like a weekly chart that is the first chart that I would like to show on euro yen. I'll show like a 2 more, I think, Japanese yen long trades. But first of all, this is the like if you want to play long-term game. If you want to play short-term game, you can come to 1-hour chart and expect this price to come around here and to be short around here. I wouldn't try to be long on this, no matter what. If it breaks out from here, I don't care, because the general narrative on Japanese yen is, I think, bullish to me. It's not like a strongly bullish, but the interest rate differential mentality, it supports the idea of to be long on Japanese yen. So there's a potential you can put a sell limit order now around like 157.2 levels and to be short around here. That might be a good game plan in a short term. In the long term, you can be short just around here, just now, and maybe you can put a stop around here, and that's more long-term game scenario. When you go to Canadian dollar, Japanese yen, I think I had mentioned this in the latest video. Same mentality here in the weekly chart. I'm waiting to be short. It's more likely, but compared to the other one, as just remember that Canadian dollar is like impacted, like being impacted from a lot of factors like tariffs, oil price, the surprise inflation spike, and they cut rates in the like a latest central bank meeting, which is they cut, then inflation spiked. That brings uncertainty. It's a bit difficult to trade Canadian dollar, but if you want to take, if you're like a risk bearer, just this is a good opportunity, I think, in the long term, and it might, like, those uncertainties always might serve into your favor for sure. And let me skip to pound long trade ideas quickly. Euro pound. I mean, I had shown this chart in latest video as well. I'm showing you right now because I'm kind of like alerting you that I think like we might be there. That might be the trigger point for your trades. Euro pound, as you can see, this rectangle chart pattern. Pound long mentality, as I mentioned, like inflation is high. Euro side is like they cut rates. They're more in front in the cutting rate path. So with same mentality, EURGBP short position, and pound New Zealand dollar. And as you can see here, I think we're here right now. It's like a, you know, on the monthly chart, like breakout pullback. I think we're there to be long on that one. When you come to the daily chart, I had mentioned this trade idea. It's playing pretty well. And let me skip to WTI. When you come to the 4-hour chart, as you can see, due to like general for this year is oil is expected to be, at least for now, to go lower as like a Trump's mentality of supplying much more oil into the market. With that mentality, I'm always like seeking for opportunities to be short on oil, and that was one of the idea. I mean, while I'm recording the video, it's already acted, but a potential pullback around here as a short-term game plan might be a good opportunity to short again. Or if you wanna just measure the just indicative chart, like a chart pattern target of this rectangle chart pattern is around here. So yeah, like around like a something like this. Like you can, I mean, this like I would wait a bit to like a bit pullback around here to be short on this one. The general mentality on it, as I mentioned, like oil supply is very expected to be high, and as you can see, the price target is highly respected level for the oil. Yeah, I mean, in this scenario, in such scenario, if the price moves around, comes up until, let me show you like this because it's a bit like a thick area. Apparently this level of, let's say, 65 level is highly respected, highly tough area for like the oil. When it comes there, I mean, I will be evaluating again with the given market conditions, but that would be much more difficult to be short around here without seeing a breakout. But I think we have some room up until there when you look at the short time frames. That's why I'm showing this like a crude oil chart as a trade idea. And gold quickly, weekly breakout, it's moving really well, pull back, go on. Okay, let's come to in the daily chart, sorry, 4-hour chart. As you can see, we're in the like there's a parallel channel, and as I mentioned in my earlier video, and now for me, along like during the way of like probably like as long as the Fed is on like a rate cutting path, which is the like a base scenario, as long as it's the base scenario, and as long as this geopolitical concerns not waning, like definitely, I will try to be bullish on the gold and like precious metals after seeing this much of like strong trend. After seeing this, like you can consider this like a huge top with handle. I think there might be still way to go for the gold, and I'm trying to find some ways to be long in gold. That's why I'm coming to like a shorter time frames, and like I think here like a below being long around here, just giving some portion of, like as I mentioned, if you have a long-term portfolio and you're trying to find a way to be long on gold, you can just like you can use your one of your bullets, one of your tickets of your, for example, you have 100k USD portfolio, you're just you're allocating maybe 20k of it to gold, and you can just buy, for example, 5k of it from here. That might be a good opportunity. But as long as gold converge to like a short-term moving averages, I expect this 50-day and this 20-day to converge a bit more, to feel more confident. As long as price converges to it's like a moving averages, I will be seeking to be long in gold. And apart from FX, like a gold, like a macro side, I want to show you quick two stocks. First of all, Nike. These are like a highly sold, like highly like I don't know, like it's like there are a lot of talks about like a Nike and Volkswagen, but the thing is, talk because they got really cheap after a point, like not cheap, but like the market went up really high. They couldn't like manage to cope with. And here Nike chart, it's not like formed yet, but we might expect here, I think there's a like a resistance maybe forming, and we might expect to see a pullback around here and the forma like a head and shoulder bottom chart pattern. That's why I just wanted to show Nike chart. And on the other end, Volkswagen chart has already formed this head and shoulder bottom chart pattern, and breakout, pullback, and 200-day moving average, as you can see, seeing a breakout above 200-day moving average is pretty important in terms of assessing the uptrend, and it happened. That's why I just wanted to give a heads up on this kind of potential long-term game plans, which has been cheap, which couldn't manage to follow the major market uptrend that we have experienced lately. That's why I just wanted to show you these two charts. And yeah, that's all I'm going to talk about this week. Thank you for your time, and don't forget to subscribe to Rational newsletter service. Plus, if you visit a Market Sol website, you'll see that there were a free ebook giveaway on the website. You can visit from the links below. Thanks for your time. I hope you have a great week.